Hi guys, welcome to Invest with George, where I break down company fundamentals and valuation. Today we're going to be walking through Oscar Health, looking at what the company does, risk facing Oscar, and valuation to see if there's an opportunity. Oscar Health is a very interesting company. They are a health insurance company that specialises in ACA health insurance, or the ACA marketplace, which is Obamacare. They have a market cap of 4.6 billion, so they're not really a small cap anymore. They're coming into the mid cap territory. They have an enterprise value of 2.4 billion, meaning they have negative net debt. They have more cash than they do debt. They had a very strong IPO in 2021 at a time when the market was very liquid. SPACs were trading at very high levels, and they crashed in 2023 or over the years as they had no profit. They had a very low membership in their they had a very low membership count and not much in revenue. And they've since recovered as their membership count has grown in the ACA, and as they have gained more market share. I think their market share was maybe around 3%, and they've grown to 8% market share in the ACA marketplace. Their membership count has grown, and they've also gained in revenue massively, but they've kind of been stuck in this trading range over the last 2 years. There's quite a lot of uncertainty around Oscar because these enhanced subsidies are going to expire, which we'll talk about later on, but they could be in a very good position over the next few years as a growing company, maintaining revenue above 10 billion. If they can get to a 5%, 4%, 3% margin. Obviously health insurance margins are very low, but at over 10 billion in revenue, they could be undervalued, and we'll look at the valuation later on. But first, let's look through the company fundamentals and look what the company does. So as a health insurance company, one of the key KPIs is their medical loss ratio, which is expressed as a percentage, and it's essentially telling you the percentage of earned premium. So obviously with the health insurance business, or the insurance business generally, you collect premiums on the insurance you're selling every year, and the loss ratio reflects how much is going to be paid out in claims, or how much has been paid out in claims in the period. So the higher the medical loss ratio is, the less profitable the business is. So ideally, in an ideal world, you want medical loss ratio going down, and this has been a problem with many health insurance companies across the US, with 2025 being a year of higher morbidity, higher healthcare utilization, and higher than expected medical loss ratios. Oscar also is a growing company, so their membership count is indicative of how much revenue they're producing, and obviously we want the membership count to going up. And so Oscar mainly serves in the ACA marketplace, which is Obamacare, where individuals essentially go to their local state websites and they look around for health insurance, and they pay premiums every month. They enroll at the end of the year, and they pay monthly until the end of the year again, and they enroll beginning in November. And the ACA marketplace grew massively with the help of the American Rescue Plan Act in 2021, which brought in these premium tax credits, which made the ACA marketplace more affordable. As you can see, brought in 2021 when ACA enrollment was 12 million Americans. It now is it's more than doubled in that 4-year period into 2025. And Oscar's membership count has also grown from 600,000 to over 2 million now. And their market share has also increased around, it's gone from 3.5% to 9-8% in that time. Now, the American Rescue Plan Act brought in these premium tax credits, but the Inflation Reduction Act extended them until the end of 2025. So a big question mark with Oscar is what happens after 2025? What happens to the what happens to the ACA marketplace, and what happens to Oscar's membership count, which we'll talk about later on. Oscar isn't yet profitable, so they're targeting profitability of $2.25 in 2027 and operating margins of 5%, which is EBIT. So at over 10 billion in revenue, that's roughly 500 million, 600 million at 12 billion in revenue. The sell side looks pretty negative. From what I remember, there's no buys on Oscar Health at the minute. It seems that the sell side doesn't know how to forecast the business, and there's kind of two key problems. The first problem is, well, Oscar Health isn't already profitable, and the other point is that, I think the market is uncertain about if management are going to pull this guidance because the ACA marketplace is having these enhanced premium tax credits expire, on top of the fact that this has been a terrible year for the health insurance sector, which is already a low margin business. So I think the sell side doesn't know how to forecast this business and is uncertain, and is probably expecting that if management pull guidance, they'll probably pull it within the next 12 months, and that'll be negative for the share price and the valuation, and sentiment will become even more negative if that happens. So what happens when these enhanced subsidies expire? That is a big question. Oscar's benefited massively from these enhanced subsidies, as their revenue from 2021 has grown from 2.7 billion all the way up to over 10 billion, estimated for this year 12 billion. And the Kaiser Family Foundation are estimated a 100% increase in ACA premiums next year, which is a huge jump. And I've seen different predictions. I'm estimating a 15% drop, some estimating a 20% drop in ACA enrollment. And it's interesting because the market is expecting this 20% drop, right, in the ACA enrollment, as Congress isn't going to extend the subsidies next year. Prices are going to go up. Many will lose coverage. It won't be accessible or affordable for some Americans. But revenue isn't dropping as much as the enrollment is going to drop by. At least that's what the sell side are estimating. Still revenue above 11 billion. And it's probably coming from the fact that the market is expecting a massive repricing for Oscar Health to increase the price of their insurance plan. So each member will be paying more towards Oscar, contributing to their revenue and kind of offsetting the losses in membership count. And there's probably some growth coming from ICHRA as well, which we'll talk about later on, which is a growing marketplace for Oscar. Now, as you can see here, these enhanced premium tax credits expire. The Kaiser Family Foundation are expecting a doubling in price, which is absolutely huge. It's probably going to be the largest increase in premiums in health insurance in the US since 2018. But not all of this is to do with the premiums finishing about, like I said, about maybe an 18%. 18% is roughly estimated to come from price increases from ACA health insurers, and the remaining amount is coming from the fact that the government is no longer spending as much on the marketplace and it's reducing affordability. But Oscar seems to be pretty positive. They're estimating that in 2027, without the subsidies, they're still going to have an addressable market of 24 million lives in the individual market. So most of that is ACA, which is this bar, which is estimated to kind of go down then stabilize, and this new marketplace, which is ICHRA. So for those who don't know what ICHRA is, ICHRA stands for individual coverage HRAs, which is essentially where the employer or gives their employees, $500, $600, $700 a month to go and buy their own health insurance. And the benefit of that is, well, individuals can go and select the plan that works for them based on what their healthcare needs are. Whereas traditionally with large corporations, employees, the HR benefits individual will negotiate for the whole organization. And so everyone is like a one size fits all for the employees of the business. Whereas ICHRA allows the employees to go and buy their own health insurance. And it's more suitable for smaller companies who don't have that negotiating power. If you're negotiating for 5,000 employees, you have a lot of negotiating leverage with the health insurance company. If you've got 100, 200 employees, you don't have as much power. Also, as a HR person, you have less resources and time to go negotiate. Whereas using ICHRA can alleviate a lot of that work, especially if you have less resources. So Oscar are estimating that if their subsidies were extended into 2027, there'd be another 7 million members in the marketplace. But they seem to be positive in that they think they'll still hit their target. So they've communicated that they still think they're going to hit these 2027 targets, even if these enhanced subsidies expire, which is really interesting. And so they've got a target of a 5% operating margin, which is EBIT. So if they have over 10 billion or 12 billion in revenue, that's roughly 500, or you just say 500, I'm not writing this very well, to 600 in revenue, in EBIT. But to get to this amount, what's interesting is that, if you multiply this figure by the share count, which is roughly 260, that's about $585 million, right? And so you can see here, if they hit 500 or even 600 million, right, that's EBIT. You need to take off your interest and you need to take off your taxes. So Oscar doesn't have a lot of debt, so their interest won't be very high, but their taxes maybe. Obviously, they've not been profitable for many years, so they can utilize the losses from the previous years to offset the taxes when they are profitable. So maybe that's how they're getting to this net income target to reach $2.25 in EPS. Now Oscar is pushing ICHRA, so ICHRA is a new marketplace that's growing. Oscar is partnering with a number of vendors, brokers and affinity groups to allow employers to kind of implement it easily, and also have Oscar accessible as one of the options and health insurance providers on these platforms. So for these larger health insurance companies like United Health, who have tens of millions of members, ICHRA might not move the needle for them. For a smaller player like Oscar, who can be nimble and can go into a marketplace and grow as a disruptor, they have a greater chance of being a huge beneficiary of ICHRA, rather than these larger players who have tens of millions of members and who probably know about ICHRA but aren't small enough or nimble enough to move quickly into the space like Oscar can, which is a main benefit of Oscar's thesis. So this is where it gets interesting. So Oscar right now, they have 2 million members. The expectation is, that's going to drop when these enhanced subsidies expire. How much is it going to drop by? I don't know. Maybe, 20% in 2026. Maybe overall they drop 30% overall over the next 2 years, which will mean they drop to around 2.4 million lives or 2.4 million members a year in membership count, which is a huge drop. And obviously, like we said before, each member will be paying more. The price of health insurance will be going up. So even though there's going to be a drop in terms of economically, the company is still going to be generating a decent amount of revenue, over 10 billion. But this is where it gets interesting, is they have an 8%, 9% market share in the ACA marketplace. What sort of market share will they have in ICHRA as an early mover in ICHRA? Is it 5%? Is it 10%? Well, even if you use the midpoint, if you use 7.5% market share, that's roughly 435,000 lives. At 9.4 million at 7.5%, that's roughly 705,000 members. So you can quickly see, obviously this is every 2 years, you can quickly see they're offsetting the losses in membership count. Obviously each member will be paying more, so it kind of supports the fact that they're going to be generating well above $10 billion in revenue, and growth could be accelerating, into the 2030s. At that point, if they're generating a profit, the multiple on that profit will be quite strong if they are growing. If they're 5, 7, a 10% market shareholder in the ICHRA marketplace as an early mover, which means they could be materially undervalued. So before we go into valuation, we're just going to look at the quarter performance. Obviously, this is the issue this year with many health insurance companies in the quarter, communicating higher medical loss ratios. It's been a huge jump, higher risk adjustment accruals, higher risk adjustment payments as well. So the expectation is next year when Oscar reprices, this will drop in an ideal world. And you can see also in the 6 monthly compared to last year, there's been a massive jump in medical loss ratio. But in terms of SG&A expense, where they're implementing AI to bring down their medical loss ratio, and they're also implementing AI to reduce their SG&A expense. They have a target of reaching a 16% in SG&A as a percentage of revenue. And over the last year, roughly 1% drop in the expense ratio, which doesn't sound like a lot, but for a company generating $10 billion in revenue, each percent is 100 million. For a company that's valued at 4.6 billion, that is a substantial amount of money. And obviously falling back to 16% over the years if they can reach this target in 2027. From 18.7 to 16%, if you annualize that's 270 million or $270 million in revenue. That's going to the bottom line. So as Oscar becomes more efficient, implements AI, they could have huge upside in terms of their profit because they're generating so much revenue. And I'm not saying health insurance is a high margin business, because it's not, but as they become profitable, even at a 4% margin on over $10 billion in revenue and growing, could be substantial for a company valued at $4.6 billion. Now let's look at valuation to see what Oscar could be worth. So this is the Invest with George website. It's not a live website. I have built a DCF tool into the website, which I use, and it's not live yet, but it's something that I'm playing around with. The whole point of this DCF is to simplify the DCF process. So we're going to walk through Oscar Health. They have roughly 260 million shares and a share price of $18 a share. They have net debt of $2.569 billion. And they did issue some convertible notes, so their debt will increase in the next quarter, next week. They've issued convertible notes for the value of 355 million. But as their debt levels go up, so will their cash balance, so that will kind of offset. From the proceeds, it will offset the net debt, and it will keep it the same. Exit multiple, I'm using a 15 times EV to EBITDA multiple. The reason I'm giving a relatively strong multiple is because over the next 5 years, I think growth from ICHRA will offset the losses from the ACA marketplace once it stabilizes, and Oscar will be a growing company. Discount rate, we'll leave that at 10%, perpetual growth rate of 2.5%. As for the projections, I'm going to use a hybrid approach where I'm putting projections for the next 2 years, and then the growth rate is going to apply it for the next 3 years based on where year 2 is. So I'm kind of cheating here. So year 1, I'm kind of going to use 2026 figures. So in a traditional DCF, you would include the year that you're in, and it would say, okay, well, we're including the 15% of days. So whatever figure you put here, it would multiply it by, there's 15% of days left for 2025. We're simplifying it to make it easier to understand. So we're going to put 0. I have seen some figures. I think I did see some figures that were positive in terms of EBITDA for 2026, but I'm going to be a bit more conservative. And I believe the free cash flow projections are around negative 275 million. Okay, so as for year 2, this is our 2027 target. So management are targeting a 5% EBIT margin. This is EBITDA. So this will need to be a higher, because it's not accounted for depreciation and amortization like the EBIT margin has been. So if they're targeting, a EPS around that figure, they would have to be producing roughly 600 in EBIT would be roughly 630, because it includes depreciation and amortization in EBITDA. Does that make sense? Am I explaining that right? 600 would be roughly what they need to hit their EPS target, right? But this is EBITDA, which means we need to add maybe another 30 million for depreciation and amortization. But I'm going to be conservative, and I'm going to say they miss their targets. They're going to do 450. So they're still quite positive. I'm not putting near break even. I'm not putting a few hundred million. It's still a decent amount. And then I'm going to put 350 for free cash flow, representing that, some companies, their EBITDA to free cash flow conversion can be 60, 70, 80%, depending on the company. And then we're going to use 10%. I think 10% is fair. Actually, let's use 12%, and then we can use a conservative example as well. So basically saying that this growth will be coming from AI operating efficiencies and the fact that they can be growing through ICHRA. So if we press calculate, you will see what the model was spitting out. So it's saying, okay, well, the current price is $18 a share. Based on the intrinsic value calculation, we're getting almost $33 a share intrinsic value and an 82% upside. Obviously, bear in mind, a DCF is meant to serve as a reference for your assumptions or a floor. It's not meant to say this is a perfect way of valuing a company. It's just a simple way to see what a company could be worth based on the assumptions you have. So as you can see here, we've got this is the present value of the future cash flow. So if we go here, what we're doing is we're discounting the cash flow back for each year by 10%. We're adding them up, and that's how we're getting 939 million. And then we also need to calculate the terminal value of the business, which is what we're doing here. So we're using a hybrid approach where we're taking the exit multiple. So we're getting EBITDA for the 5th year, multiplying it by 15. That's giving us a terminal value of almost 9.5 billion. And then we've got to discount that back 5 years, and that's how we get 5.88 billion. And then we also need to do, you could use either one of these. I'm using both of them. So we also have the perpetual growth method where we're getting the free cash flow for the 5th year. We're putting a perpetual growth value in it of 2.5%. That gives us a valuation of 6.7 billion. We discount it back by 5 years and we get 4.1 billion or 4.2 billion. So what we do is we add these two figures up, or we just divide by 2. We take the average, which is 5 billion. So we take 5 billion and we add it to the cash flows over the 5 years. And that's how we get our enterprise value. We also need to subtract the net debt, because obviously we have more cash than we do debt. So we need to add it back to the equity value, and that's where we're getting 8.5 billion dollars from. We divide that by the share count, and that's how we're getting the intrinsic value calculation. If we go down, there's also a sensitivity table. So this is saying, okay, well, different variables, what could the company be worth? If the exit multiple is slightly lower, or the perpetual growth rate is lower, well, it's still saying that at 11 times multiple, based on the projections that I've put, and a 1% perpetual growth rate, the company still has roughly 50% upside, or more than 50% upside, if those projections are accurate. But we can also be more conservative. So if you wanted to say, okay, well, let's also build a more conservative case. Oscar did recently issue some convertible notes, and if they wanted to settle those convertible notes in share capital, they didn't want to use any cash. That would dilute the share count by roughly 15 million shares. Also, let's say the net debt is lower. Let's use a 1.5 billion net debt position, negative net debt. EBITDA multiple, let's say it's 12. And then as for the projections, I'm going to keep them the same, but I'm going to move this low. So let's say they grow at 6% a year from ICHRA. or they're growing their profits, their EBITDA and their free cash flow by 6% because of ICHRA. And we go calculate, we'll get a different outcome. So it's saying, okay, well, based on these assumptions, you're getting a 22.22 intrinsic value per share with 23 or 24% upside, which is more conservative. So obviously, the different assumptions you use will determine, what the valuation could be worth. And it's important to understand that these are just assumptions. You take them with a grain of salt. Sell-side analysts get it wrong all the time. It's just to serve as a reference point of what the shares could be worth, so that when the company reports, you have an understanding of what the intrinsic value per share is. I hope this video helped you understand Oscar a bit more, understand some of the risks of Oscar, some of the issues they're facing, what the valuation could be worth. Always do your own research. Oscar is a smaller cap company, so it is more volatile. It's not profitable yet, so there's going to be high volatility, especially in the next year. So appropriate position sizing is relevant. So I hope you guys enjoyed the video. Thanks for watching, and I'll see you guys next time.